Hey traders, Mike here. In my past videos, I profiled many successful hedge fund managers, and one specific hedge fund manager always pops up in the news. Now, his fund is part of the legendary and exclusive Tiger funds. His name is Chase Coleman. So in this video, I'm going to profile Chase, one of the most successful hedge fund managers in the world with a personal net worth of over $8.5 billion, and share with you his investment strategy. So let's get started. Chase is an American billionaire hedge fund manager and the founder of Tiger Global Management, one of the biggest and most profitable funds in the world. Now, his firm focuses on investing in both publicly traded and private companies, mainly in the technology space. In addition, they operate several funds, including a hedge fund, a long-only fund, and several venture capital funds, managing a total of over $125 billion worth of capital. How Chase got his start in the investment world was in 1997 when he went to work for Julian Robertson, the superstar hedge fund manager, as a technology analyst for his firm Tiger Management. Now, Julian, who became Chase's mentor, saw something special in Chase. And in 2000, when Julian decided to close down his own hedge fund, he entrusted Chase with over $25 million to manage. Chase, who was only 25 years old at the time and had only been a researcher at Tiger Management for 3 years, became one of the 30 or more so-called Tiger Cubs, fund managers who started their fund management careers with Tiger Management. Now, some of these legendary Tiger Clubs include Stephen Mandel Jr. and Lee Ainsley III. Now, Chase certainly didn't disappoint his mentor, as over the years, his long-short fund had a compounded return of 21% net since its inception in 2001, with only 2 down years in 2008 and 2016. Now, an investment in the fund at inception would have grown 43 times net of fees over the last 20 years. Now, another one of Chase's fund, Tiger Global Long Opportunities, has a compounded return of 22% net since its October 2013 launch, while the firm's private equity business has generated a 33% gross fund internal rate of return. In fact, one of his best years was in 2020, where Tiger Global earned its investors $10.4 billion, more than any other hedge fund on the annual list of the top 20 managers in the world. Before I share the details of Chase's trading strategy, please take a moment to like this video. I would really appreciate your support. Now, there are 2 main strategies that Chase uses to manage his investors' capital. Now, one is where he draws on one of Julian Robertson's core philosophies, which was to buy the best companies and seek to identify high-quality businesses levered to the most important secular growth trends. Now, it's not a complicated strategy, but the key aspect of it is how aggressive Chase and his team would buy up large cap growth stocks like Apple, Amazon, Google, and Priceline, and then hold on to them through a bull market. Now, if he wanted to boost his returns, he would apply leverage to these individual stocks. An example of this is his firm bought 300,000 shares of Priceline, a fast-growing online travel agency, in 2009, and then more than tripled his position in 2011. Now, by the time he sold his position, this single stock alone made the firm almost $200 million. Now, another long-term holding is Apple, representing 11% of the firm's publicly disclosed positions at the end of 2011, which is estimated to be more than 1 million shares. Now, it's reported that this Apple position made the firm over $300 million. The other strategy is Chase likes to buy stock in private companies that are heading towards an initial public offering, or IPO, and then Chase would sell the stock at a huge profit to investors who can only buy in after the IPO. Now, an example of this is Chase's firm purchased a huge stake in Yandex, the Russian internet company, and filings showed that his firm accumulated 62.3 million Yandex shares at evaluation prices between $3 to $5 per share for a 71% stake in the firm before the IPO. As the company went public in 2011, the price popped up to $42 per share on opening day, and Chase's fund was sitting on a $1 billion profit. Another $1 billion profit that Tiger Global made was in Facebook, now called Meta. Now, they bet heavily to the tune of a $11.5 billion investment that Facebook stock would be worth more when the company went public. And they were right. So when Facebook actually went public on May 14, 2012 at $42 per share, the firm sold all its shares to the public, netting a massive $1 billion profit. However, after the IPO and for the rest of 2012, the stock price fell more than 50%, or as low as under $18 per share. Now, the investors who held on to this day still made a massive profit, but everyone knew who was the real winner. Now, Tiger Global was guaranteed to reap hundreds of millions or even billions of dollars by selling high-in-demand stock at prices higher than what they paid for in risky emerging technology firms. And sometimes Tiger Global was the only one making the huge profits. For example, Longtime Financial Technologies was a firm Tiger Global controlled before its 2007 IPO. Now, in 2006, the fund purchased about 10 million shares at prices ranging from $3.68 to $6.43 a share. Public filings show that Tiger management managed to sell at least 6.4 million shares as the stock soared to $40 after its IPO at $17.50 in November 2007, taking in more than $150 million in profit. However, long top shares crashed to zero not too long later after the firm was accused of accounting irregularities. However, not all of Tiger's pre-IPO investments have turned out badly for those who bought in later. Now, for example, the firm bought 3.7 million shares in LinkedIn at an average price of less than $17 per share before that company's May IPO in 2011. Making at least a paper profit of at least $250 million. Now, investors who held on to the stock profited immensely when LinkedIn got acquired by Microsoft for $196 per share in 2016. Basically, Chase and his team leveraged their incredible buying power to rack up huge profits by jumping in ahead of retail investors. As mentioned, Tiger Global also had a very successful venture capital business, which was led by his right-hand man, Scott Scheffler. Now, it started in China in the firm's early years, where in 2002, they had huge success investing in 3 China internet companies, Sina Corp, Sohu.com, and NetEase. Now, dubbed the Yahoos of China, all of them appreciated tremendously over the years. Sina went private at a $2.6 billion valuation. Sohu went from a dollar stock in 2002 to over $100 per share in 2011. NetEase went from a penny stock at under 10 cents to over $130 per share in 2021. Now, with the success in China, Tiger Global branched out to include US companies, and they famously backed Facebook and LinkedIn in their early days. Now, Facebook, now called Meta, is worth $600 billion, while LinkedIn got bought out by Microsoft for $26 billion. 2 huge winners for them. The key to their success is to find companies that are growing incredibly fast and then throw money at these companies with a size and velocity that allows them to grow even quicker. Now, the term balls to the walls is how one of its investors described the firm's approach versus a more traditional approach where investors would invest in companies based on profitability as a key metric. With Tiger Global's aggressive approach, this led them to dominate the venture capital world, particularly in 2021, where they backed an incredible 335 deals, which equates to more than 1 investment per business day. Now this model worked really well, and with its aggressive style, Tiger helped drive up the valuations overall for the companies that they invested in, boosting the rise of the so-called unicorns, privately owned startups worth more than $1 billion. Now in 2022, there were 1,338 of them, and Tiger Global invested in 351 of them. With all the success that Chase and his Tiger Global empire had, they were not immune to the bear market in 2022. In fact, 2022 was one of its worst years as its main fund lost half of its value. Now, Tiger Global became the poster child of the tech meltdown because of its sizable bets on companies such as Peloton, Roblox, Uber, Robinhood, Warby Parker, and Carvana, where some of these stocks have fallen by more than 90%. Now it just goes to show you that when there's big rewards, there's also big risk. If you like this video and want me to profile other top traders like Chase Coleman, please like this video and comment below on who you want me to profile next. Also, please click on the left for more top trader videos and the right for top trader playlists. I'll see you guys all in the next video.